My biggest fear is that at some point there's going to have to be a financial reset where, all these countries that have just printed and taken on massive amounts of debt to GDP, there's some sort of collapse that it creates the birth of some new sort of financial system, some with checks and balances where governments have to have a balanced budget by law, stuff like that. We are going to have to go through something that's very akin to the Great Depression. And I worry it could be even worse than that. And so, there will be a lot of growing pain.
Gareth Soloway, President, CEO, and Chief Market Strategist for Verified Investing, examines the recent economic conditions. The critical question is whether inflation will return to 2% as the economy slows and consumers reduce spending. According to Gareth Soloway, there's going to have to be a financial reset. Many countries have printed money and taken on massive amounts of debt relative to GDP. Following a recent Congressional Budget Office report urging Congress and the White House to address federal spending and debt, it's crucial to recognize that high debt levels have tangible consequences beyond figures on paper. The CBO's projections, under optimistic assumptions excluding anticipated congressional adjustments to tax and spending policies, indicate that debt could reach 122% of GDP by 2034. This would surpass defense spending this fiscal year in terms of interest payments alone. In a previous CBO report, it was highlighted how increasing debt levels could reduce Americans' prosperity, potentially lowering per-person income by $14,500 by 2054, assuming debt reaches nearly 3 times the size of the U.S. economy. Soloway raises concerns about the global debt-to-GDP ratio and the implications of government's extensive money printing. He predicts the possibility of a financial reset necessitating a new financial system with stricter fiscal controls, such as balanced budget requirements. The inflation rate based on personal consumption expenditure, PCE, in the U.S. rose 0.3% in April from the previous month, maintaining a similar level to March, the previous month. On the other hand, core PCE prices, which were calculated without raw materials such as food and oil, rose 0.2% from the previous month, down from 0.3% in March, and below market expectations. Looking ahead, Soloway warns of a more volatile inflation environment, where rapid increases could challenge the Federal Reserve's ability to stabilize the economy. He suggests a future financial reset may be necessary due to excessive global debt and suggests potential roles for physical metals and cryptocurrencies like Bitcoin in the financial system. Now let's break down what this all means, of course, with Gareth Soloway. Before we continue, let's take a minute to subscribe to our channel and hit the bell icon for more timely updates.
So originally, back when we were at 7-8% inflation, I was saying that, listen, we'll fall to 3% and then we'll start to kind of stabilize and hold around 3 to 4%. We've done that. Now, the bigger is as the economy slows and the consumer continues to pull back, do we see inflation coming back to 2%? And honestly, I do think that does happen. I do think inflation eventually goes down just based on the U.S. entering a recession and the consumer just being stretched at this point. But one of the things that I think is going to occur is that the Federal Reserve, as soon as, honestly, they'll probably cut even before we're at 2%. But when they start cutting aggressively as we near 2%, my guess is it's going to cause a rocket ship back up of inflation much faster than in the past. And so even if we do come back to 2%, my guess is within a year of that, you see inflation back above 3%. And I don't think we're in this period where you have the olden days where we could be at 2% and stay at 2% for years or even decades. I think that, again, we're in a much more trigger-happy environment of inflation where we're now going to see that a drop in interest rates is going to kickstart inflation much, much quicker again to the upside. And that's my big fear, is that we're now in a cycle where things are happening much, much faster, where inflation will go up very quickly, and it's going to put the Federal Reserve on their heels in terms of not being able to rescue the economy like they used to. My biggest fear is that at some point there's going to have to be a financial reset where, all these countries that have just printed and taken on massive amounts of debt to GDP, there's some sort of collapse that it creates the birth of some new sort of financial system, some with checks and balances where governments have to have a balanced budget by law, stuff like that. But it does bring up the question of, number one, physical metals having a bigger role in the future, and then also cryptocurrencies and things like Bitcoin maybe having a bigger role as well in terms of backing the U.S., right? I mean, imagine if there was, maybe this is where the CBDC comes into play too, where it almost rescues the financial system, but it rescues it with predetermined expansion to it, right? So for instance, imagine if the monetary supply was only allowed to expand, let's say 2% a year versus the government being able to just print ad nauseum, or the Federal Reserve being able to print ad nauseum. So my guess is something like that will occur. The problem is to get to that point, we are going to have to go through something that's very akin to the Great Depression, and I worry it could be even worse than that. And so, there will be a lot of growing pains.
Discussing the current economic landscape, Soloway points out the challenges posed by upcoming election cycles. He notes that recent economic data has provided some justification for the Federal Reserve to maintain rates, citing moderate inflation and a resilient economy. The main focus of the U.S. economy has shifted to the 2024 presidential election, as central banks are cutting rates and politicians are spending more, creating optimism for the election year. According to a report by Saxo, an investment bank, on the quarterly outlook for Q2 2024 of the U.S. economy, the economic data is strong in the first quarter, but signs of weakness are emerging. Soloway emphasizes a cautious approach by central banks amid a polarized political environment, suggesting they may prefer to delay significant policy changes until after elections to avoid further controversy. Let's shift our focus to a video.
In general, it creates a scenario where you don't allow the natural course of economics to play out. Like if you look at cycles, the seasons, the solar cycle, the lunar cycle, everything has a cycle. We all have cycles in our lives, that we abide by. We go to sleep, we get up. The economy has a natural cycle. It has expansionary periods and contractionary periods. When you don't screw around with the cycle, the expansionary periods are solid. The recessions are lukewarm. They're not horrible. When you mess with the cycle and don't allow recessions to occur because you print right away and you just lower interest rates, then when we do get one, it's 10 times worse. Think about it like this. If someone never got sick and they were kept in a bubble, and all of a sudden they were removed from that bubble, they would get so much sicker because their immune system was not actively made to combat those issues. And that's now what we have in this financial system, and really globally with many countries out there. I think on the positive side, the data up till this point has kind of allowed them, right? Inflation stayed a little higher, so they can say, oh, we can't cut rates yet. And at the same time, the economy's staying relatively strong, so they don't feel the need to. I did see Neil Kashkari over the weekend coming out and saying we won't cut rates likely till December. And again, that perfectly puts it after the November elections. But the question I have is, well, what if the stock market collapses 10%, let's say over the summer? Are you really going to hold back to that? What if we start to see unemployment skyrocketing? So I think they want to try to remain neutral because, needless to say, especially here in the U.S., everything is so polarized at this point that no one wants to step in the middle of that. So they would prefer to wait to December. The question is, are they going to be able to? And if they, this is the kicker, is that even if the data shows that they need to cut or they do cut, it will be made into a political thing if it's done before the election, because that's just the way our media is and our system is at this point. But I truly believe that they don't want to mess with that. I mean, if they're like me, man, you just want to stay out of that whole mess. It's just a nightmare, to be honest.
U.S. economic history warns that raising the cost of public and private borrowing increases the danger of recession. In 2024, this risk far outweighs the risk of renewed inflation. Starting with GDP in the first quarter, a series of consumer production indicators, including personal consumption expenditures in April and manufacturing PMI in May, all predicted a downturn in the economy, leading to a sharp drop in government bond rates in the U.S. financial market. How do you perceive the current balance between controlling inflation and avoiding recession in the U.S. economy? We value your thoughts, so feel free to share them in the comments. If you found this content valuable, please give it a thumbs up and remember to subscribe to stay informed. Thank you for being part of this journey with us.